we have what we call the bid-ask spread now in the acquisitions market. Nobody wants to sell for the price everybody wants to buy for. That's going to close itself because it's going to be driven a lot by the financing that's available. The people that can probably do lower leverage financing may be able to take advantage of some of those opportunities in the short term. And then, people who are buying or otherwise, going to have to wait until the sellers sort of come back to them.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 410. With inflation, higher interest rates, and an encroaching distress on the real estate market, it's a challenging time to navigate our portfolios to a successful outcome. My guest today has what it takes. Jon Siegel has advised clients on over $25 billion in multifamily transactions. He's worked with HUD as an exclusive loan sales advisor, served as director of structured transactions in Fannie Mae's multifamily group, and served as director of acquisitions for the largest owner and manager of multifamily real estate in the nation. Today, we all get to benefit from Jon's 30 years of experience to identify tips to long-term success in multifamily and real estate investing. Jon, welcome to the show.
Yeah, thanks for having me. Appreciate the introduction.
You have an incredibly impressive background. Why don't you just fill us in a little bit about how you got into real estate and how you became so impressive?
I always say now I've been in multifamily for longer than I care to admit, but it's probably been, a little more than 30 years. I actually fell into, like most people, there's a saying that I heard that said, when you find that thing that everybody else thinks is boring and you think is interesting, you probably found your thing. So maybe that's how I got into this, but I really sort of fell into it. I actually, believe it or not, when I got out of college, I worked for a radio station, and I worked on the morning show of a radio station, and I got paid $4 an hour or something like that, and had to get up at 6 o'clock in the morning, or it was probably 5 o'clock in the morning. And it wasn't as much fun as it sounds. And, everybody, my parents, my girlfriend, everybody was like, when are you going to get a real job? And so I just started talking to people, in my circle and in my parents' circle, and ended up getting a job with a company that was in the apartment business, which I didn't even know existed. I mean, I knew there were apartments, and so that started it. And I actually ended up going to business school. And I went to business school thinking, maybe I'll go be like a studio executive in Hollywood or something like that. And then, when I went to look for a job, and that was actually in the early 90s, so not a great job market. And the only people that talked to me were people in the real estate business and in the multifamily business, because I had that on my resume. And it sort of went from there. At every turn, I have sort of, traded hopefully up in the business and kept going. So eventually now that I'm an old guy, I guess I can say that I know what I'm talking about.
You have consulted on billions of dollars in real estate transactions. And what I'm impressed by is your experience, your HUD background, your Fannie Mae, your institutional background. So I would think that you look at real estate, and especially multifamily, on a much higher level perspective than a lot of us do. And I'm wondering, how did you kind of transition into that multifamily, and how did you help advise on $25 billion worth of real estate acquisition?
Yeah. So my first job when I got out of business school, I worked for a company that was the largest owner of apartments at the time. And they were actually buying loan portfolios. It was back in the days of the RTC. So only old people will even remember what that is. But that's, the government was selling a lot of defaulted loans from one of the last financial crises. And, we bought a couple of those. And the company that I worked for was actually owned by the endowment of Harvard University, which was kind of an interesting random thing. And they decided that they really thought there was a great long-term play in multifamily. And so it was the largest company, but back in those days, things were not as institutionalized as they were. And they said, we're going to try to grow the company. We're going to try to buy some companies. We're going to try to, buy a lot of real estate. And I like to say that the company was, I don't want to say it was so poorly run because, it had some good people there, but I was in my 20s. I was willing to stay up all night and travel on a moment's notice and do whatever it took. And they ended up just letting me do stuff that I would not have let me do at the time. And I really had no idea what I was doing, but I did it. And, it worked out. I went to a closing once on Wall Street. We bought a portfolio of like 5,000 units, which at the time was a really big deal. Still would be a big deal, I guess. And we went to the closing, and everybody sat down to sign the stuff. And they looked at me and they're like, well, who's coming from your company? I'm like, I'm here. And they're like, you're the guy that's going to sign the stuff? And I was like, yeah, they said I could do it, so I'm doing it. So, I guess that's a little bit of saying, it's fake it till you make it. And then I ended up, when I left there, and I thought that was, at the high end of business, but when I went from there to work at Fannie Mae. And when I worked at Fannie Mae, I always say there's a whole other set of zeros at Fannie Mae because, it's one of the largest companies in the world, and they would lend, billions of dollars at the time, billions of dollars, which now is tens of billions of dollars in a year. And again, it's a whole set of zeros. And people would be like, wow, that's a lot of money. And I'd be like, well, it's not like I get a piece of it. So there's, to me, it's just another number on a spreadsheet sort of. But, when you do that, you start to learn all the stuff. So, I think the largest deal I did at Fannie Mae, we did a deal it was called, and this is one when we talk about advising too. There was a REIT back in the day called Archstone, and it was a very large multifamily REIT, one of the biggest ones in the country. And it had been taken private. It was being taken private by Lehman Brothers. So this was in 2007. And we ended up doing $7 billion of debt for the privatization of this deal with Lehman Brothers. And then that was in 2007. And then about 6 months later, Lehman went bankrupt. And I was like, that's not good for the deal, is it? And so I ended up spending then 5 years after that doing a workout on that deal. So as we start to say, you advise on all these deals, a lot of them just happen. I went from being on the principal side to being a lender, and now I'm back on the principal side. And so sort of just, moving along with the flow and trying to find interesting things, has fortunately for me opened up a lot of, interesting projects, I guess.
But I'm curious, like the trajectory there and the perspective on multifamily real estate from the beginning, when you were kind of starting out was it the early 90s?
Yeah, 1992. Yeah.
92, yeah. So what was your level of sophistication then, and the way you valued and the metrics you looked at when you were viewing these portfolios versus how it is now?
Yeah, no, that's a great question. It's interesting because in many respects, the analysis that we did is kind of the same. Like we were sort of the first users of Excel, and so we were building Excel models, and we still here at my company today have an Excel model that we use. So to a certain extent, the basics of the math are the same, but the level of information that we have access to is, it's light years away. And also, the industry itself has changed so much. I mean, when I got into the business, it was not a very institutional business. We were a large company. We were one of the few, though, very large companies, and one of the few public companies, the one that I work for. And most of the companies were pretty mom and pop. And the business has really evolved, through, I think the term we would use is securitization, right? Where debt became much more available and the equity ownership became institutionalized as well, with all of the REITs and now all the pension funds that invest in multifamily. It used to be that multifamily was sort of a stepchild of commercial real estate, right? Everybody wanted to be in the office space or, office or retail. And now, the script has been flipped just because, all the changes in the world. So as you say, in many respects, the math that we do is the same, but the access to information and the number of people that are in it and the sophistication of the people that are in it is, it's light years away. But, just as an example, going back to when I was first an acquisitions guy, if a broker had a deal for you, they would call you and then they would try to pitch it to you on the phone. And then if you said you were interested, maybe they would send you the stuff in the mail or maybe they'd FedEx you the stuff. Email existed, but it wasn't like that. And so, in many respects, though, I guess for something like that, there was, I think the term would be asymmetry of information. So you could have more information than anybody else, where now, first of all, I can find out today. I went to a meeting, I came back, I had 70 emails, 68 of which were blast emails from brokers talking about deals. So I can find out about so many more deals now. And I can go on my browser and go into my, CoStar thing and look up every deal and find out every piece of information about it in 30 seconds, where that kind of information was just not available. So that's probably the biggest change.
What does that mean in terms of opportunities? Obviously you helped companies build huge portfolios. Is that because you really had exclusive view of all these opportunities?
Yeah, I think for sure that there was definitely an advantage to being a bigger player or maybe having relationships And relationships are, at the core of everything and still are. But for sure, back, 30 years ago, 20 years ago, even, when I first started in my business now, which was 10 years ago, everything has ramped up exponentially. That has been great if you're on the seller side because, you can form an efficient market more, where before there were only, it was probably more of an old boys network. And you would get, say back when I worked for the largest owner in the country, we would be at the top of everybody's list to call. So if they called us about a deal and we said we were interested and they sent us the information, we'd have first crack at it and nobody else would know about. And we also had a portfolio of 100 and some odd thousand units. So we had the information from our portfolio, or I could just call the property management people and get the information. Most people didn't have that kind of information to know, like, hey, I'm looking at a property in Cleveland. What does that market look like? And, I could have somebody that could tell me that. Now, of course, we could just Google it or go on your CoStar or whatever and get it. But back then you had better information. So I think, it's probably more democratized now than it was back then. But, I guess there's benefits and burdens to all these things, all the evolution that we've seen.
There's certainly benefits to technology and our access to information. Have you found a replacement for that kind of choke point that you had, or that exclusive proprietary insight into properties? Given that it has been more democratized, how do you differentiate yourself now so that you still have that edge on the competition?
Yeah. It's hard now. I think, it's maybe a little easier in 2023 than it was in 2021, maybe when everything was going crazy. But, I think it goes back to the old fashioned ideal of, to a certain extent, relationships. Everybody will say they're best friends with all the brokers, and the broker's job is to be everybody's best friend, I guess. But, it is about relationships, about, we have in my company, myself and my partners, we have a lot of experience. We have a lot of people that we know. So those relationships help. But also, I think for me, it goes back to how we do business. So, I've been around for a long time now. So I have relationships with people from all different walks of life. So when we have a deal that, say, somebody has, and they take it to a broker and they're selling it, and they have 5 people in it, there's a chance that we might know somebody that works at the company that's selling it, or somebody, that has something to do with it, that can vouch for us, not just do us a favor, but can vouch for us. Because, for me, the biggest thing is that we always, do things with integrity, and we say, what we say we're going to do, we do. And that carries a lot of weight. And once you do it for a long time, people actually will buy into it. So to me, it's, maybe it's back to the old fashioned blocking and tackling of, hey, I'm not going to find out about a lot of things that nobody else is going to find out about. But, if that opportunity finds me and I'm competitive on it, they might give me the benefit of the doubt because A, I know what I'm doing, and B, I can actually, they know that I can actually do it and I won't screw them over.
What about access to capital? I mean, you have this FHA background and the institutional background. How have you seen that change since the 90s? And I mean, probably when you started, interest rates were not far off from where they are now.
Yeah, I was thinking about it. There was a guy here, I'm in the DC area, and there was a guy who owned, a portfolio like 20,000 units or something in the DC area. Old school guy who's actually passed away now. But I kind of knew him, and he kind of, every once in a while, I pick his brain or whatever. And he one time said to me, he said, kid, if you can find an interest rate under 7, you should take it right away. So, rates are sort of reverting back to the mean. But, I think the access to capital in multifamily has changed the business completely. I mean, I talked about securitization, back in the 90s, getting a loan, if you wanted to buy a property, getting a loan on it was not necessarily so easy. You had to really know where to go and what to do. Fannie and Freddie had actually gotten out of the multifamily business in the 90s. They had a bad experience where they had somebody committed fraud and they were out of the business for a couple of years before they got back into it. And Fannie's program was, sort of building at that point. So, we used to do deals we'd do securitizations on Wall Street, or, you use a bank. And so it was much harder to get a loan. And that was definitely an impediment. And again, the access to debt capital really took off, when I worked at Fannie Mae, so maybe I was sort of part of that. But the access to debt capital really took off with Fannie and Freddie. FHA has been there. They're sort of, counter-cyclical maybe, and then with the conduits in 2000. So the access to debt capital really took off. The access to equity capital, I think, was a little slower in evolving because, again, I think most really large institutions, your pension funds or, big funds, shied away from multifamily. It was sort of, they used to say like no beds in like multifamily hotels, or it was not a favorite asset class. And, we saw that changing probably. And that was sort of coincided with the start of my company here, where we actually got money from a pension fund in 2013 to start buying multifamily as pension funds, really got into the business more and more. And again, now, it's never easy, but there's, infinitely more access to capital now, which is, that's why we've seen so much transaction volume and the growth in prices and all of that.
It's interesting, the correlation there between, Fannie and Freddie getting into the market, FHA having a product, and how that's kind of like really, again, democratized the ability to buy multifamily.
Yeah, it used to be a thing like, I know somebody that can get a loan, or I know somebody that knows somebody that can get a loan from Fannie Mae. Now it's, I get calls, every day from different Fannie Mae, Freddie Mac originators trying to do business with us. So it's a commodity product now.
You know what? I mean, just to relate it to Grand Rapids, when we bought our first large multifamily in 2014, Fannie Mae and Freddie Mac, I think, had redlined Grand Rapids in Michigan because Detroit was in bankruptcy, the result, the after effects of the Great Recession. And our multifamily that we bought in 2014 was I think it was the first Fannie Mae loan that in Grand Rapids since before the Great Recession.
Yeah, no, it's interesting. They, generally, I would say that if you're, looking around the country, and they do sometimes pick markets where they might be more conservative or not play. But for the most part, one of the sort of opportunities that a lot of people don't realize, and, most people want to be in a bigger market than a smaller market. But, the price of debt, like if you're getting a loan from Fannie or Freddie, the price of that loan tends to be the same if it's in, Texarkana or it's in Beverly Hills. They don't necessarily, price based on location a lot. And so, that I think has been big for a lot of people over this last cycle, where they opened up, say, in Grand Rapids in 2014. And in a lot of smaller markets, the capital is just as available as it would be if you were in, a hot market like Austin or something like that.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
Those shifts that really changed the dynamics of investing, those shifts in access to capital are important. I mean, do you see any shifts on the horizon that would change that the access to capital? And are you looking at anything? Because you have this experience and this higher level of perspective. What do you see happening that can change the dynamics and shift things in one direction or another?
Yeah, well, I think that the capital side of the equation is definitely going to evolve here, because we've seen, what we saw, and it's interesting how, when you go through multiple cycles, you sort of see history repeat itself a little bit. It never, not exactly the same. Nothing's exactly the same, but a little bit. Say when Fannie and Freddie, at the height of their time during a cycle, are taking, a majority of the business in multifamily financing. But their underwriting standards are, pretty conservative, and they don't really change that much. Like, so as the market gets more overheated, maybe is the right word to say that, Fannie and Freddie generally will stick to their guns for the most part. Around the edges, they'll start to do it. But and their underwriting standards will get more restrictive. So we saw like back in 2005, 2006, when I actually worked at Fannie then, they had, Fannie was becoming less and less competitive. And these conduits, the Wall Street conduits were in style then. And Fannie and Freddie lost a ton of business to those conduits. And then, when everything happened with the great financial crisis, a lot of those conduits just went away and they lost a bunch of money and a lot of these loans went bad. And then, as the market starts to correct itself, Fannie and Freddie are still there and there's capital, but as long as it conforms to their underwriting standards. We saw the same thing in this last cycle where debt funds and bridge lenders filled in the space where Fannie and Freddie were not active. So if you were going to buy a value add property in most markets around the country, you could only get like a 50% Fannie Mae loan in 2020 or something, 2021. And the debt funds would step in to do 75%. Now, we all know that those loans were variable rate. Fannie Mae, you can get a variable rate loan from Fannie and Freddie, but most of those are long-term fixed rate loans. These people were doing these short-term variable rate loans thinking, what could go wrong? Well, rates went up a lot. And so people are struggling with those deals. A lot of those debt funds are going away. Nobody's going to do those loans anymore. And we're going to go back to, you have to have your deal conform to the agencies to get financing. So, I think the opportunity is in, first of all, finding deals that work like that, understanding how that works, and being able to do deals potentially with lower leverage. Most of us in the multifamily business, we love leverage. And so we always try to get as much as we can. Obviously, it juices your returns. But, there are some pretty good buys, right now or going forward, if you can do a loan, if you can buy a property and you can do it at 60% loan to value or something like that. So I think, the market is going to have to, we have what we call the bid-ask spread now in the acquisitions market. Nobody wants to sell for the price everybody wants to buy for. That's going to close itself because it's going to be driven a lot by the financing that's available. The people that can probably do lower leverage financing may be able to take advantage of some of those opportunities in the short term. And then, people who are buying or otherwise, going to have to wait until the sellers sort of come back to them.
Can you extrapolate out even further? Like, where do you see, like right now, as we record this, it's September 2023. We might have one or two more interest rate hikes before the end of the year. Just pull out your crystal ball and tell us where you see us next year at this time, 3 to 5 years out. What's going to be the change there in the capital event?
I think that, I talked to somebody else, reached out to me the other day and said, what do you think? They said pause, they paused on the interest rate hike on the last Fed meeting. And I was like, well, the Fed paused. So that helped people who maybe are looking for Fed funds rate or SOFR or something like that. But, the 10-year since that meeting has gone up probably 25 basis points or more. And so the cost of debt has gone up significantly since then. So I think where we are right now is we're in a period of higher interest rates. That I think right before we started doing this, I looked at the 10-year was up to 4.62, which is almost 100 basis points more than it was in June. So debt is a lot more expensive. And the Fed isn't going to be cutting rates. And, real estate's a long game and and things don't happen super fast. People were like, it should be better by, Memorial Day, by Labor Day. It's going to take time. It's going to take a couple of years probably now. I think for those of us that are active in the business, the biggest thing that we can have is not high rates or low rates, but stability. Right now, we just don't know what it's going to be. And so nobody can really do the math on what makes sense to buy a property or sell a property or finance a property. But my long-term crystal ball, which is as cloudy as anybody else's, is that I think we're going to have, elevated interest rates compared to the way they've been historically. Historically being over the last 5 years or our era of low rates. And, a 6% interest rate on a multifamily deal is probably the new normal for a while. And, a cycle will take root again here in a couple of years and we'll go forward from there. But I think you have to sort of dig in now. I think if you're sitting around waiting for it to go back to where it was, a year ago or 18 months ago, or whenever everything was sort of going gangbusters, I think you're probably going to miss out because it's not going to happen. It's changed.
Do you see any change in the access to capital? Kind of like the CMBS or the bridge loan providers came in earlier. Is there going to be another alternative to the Fannie Mae, Freddie Mac, HUD that is really the kind of tried and true? Do you see anything on the horizon there?
There will be. The answer is yes, there definitely will be. I don't know what it'll be because I think we're probably just ending the period of the debt funds and probably, going back into another period of agency financing. It actually, HUD tends to be sort of the counter-cyclical lender who has the most attractive terms, like, in a period like right now. But, it's a lot of brain damage a lot of times to do a HUD loan. It takes a long time. And
you used to work for HUD. So why all the brain damage? Why is it so difficult?
to clarify before anybody tires and feathers, I actually didn't. We had a contract with HUD where we were their advisor and we sold all of HUD's defaulted multifamily and healthcare loans. And so we worked closely with HUD. We did that for 7 years. And, HUD's a different animal. It's not run like a business for the most part. Like even Freddie and Fannie are run like businesses. They used to be public companies. And HUD is not. And there's a lot of bureaucracy. And there's also a lot of change in the leadership. Every time an administration changes, the leadership changes. And then, the priorities change because they go, so it's a little bit more, it's a government agency and it runs more like a government agency. And they have tried ever since I've been around to try to make it different. And, around the edges they tend to do, but I think it's one of those animals that even the people that work there just know, it's just kind of is what it is. There's a lot of bureaucracy. So, there are people that have made a lot of money and have done really well working the HUD system. Because again, you can get really good terms from HUD, but you have to know what you're doing. You have to be patient. And, it's not like calling your local banker and getting a loan in 30 days. It's, it's just settle in for a year or so. So it is what it is.
Yeah, we're working on getting a HUD construction loan right now, and it's a 12-month process.
There's always somebody that's good at working the system, and those people end up doing really well, being able to do it. And right now, if you're looking for a construction loan, that's probably your best bet, I would say.
Yeah, it seems to be the one product out there that still works as opposed to any other construction.
And I think that people at HUD would say that, part of their mission in life is to be there at this time when there are no other construction lenders. And, we need housing in America. We need affordable housing. And that's really HUD's mission would be to be there now and to be there doing loans when nobody else will do them. Nobody else will take that risk. That's the government's job to take that risk. Now, having sold a lot of their defaulted loans, they took some risks they probably really shouldn't have taken, but that's a story for a different day.
Jon, tell us your favorite hack or app. What do you like using technology-wise?
Is this in a business context?
Whatever context. It could be a life hack, a life app, a business app. What do you usually?
Yeah, well, on the business side, we're big users here of a couple different apps here. We're big RealPage. We use RealPage, and they have a lot of market data, which is similar to CoStar. It's the old axiometrics. So we lean on that. We lean on an app called Red IQ a lot that takes the data. If you get data from somebody and they send you an operating statement or rent roll or whatever, and it's kind of a pain, if you have a model or something, it's Red IQ, you put it into Red IQ and it'll slice and dice it for you really fast. It has made us our modeling and it manages our pipeline as well. It's made our lives a lot easier. So Red IQ would be a good one.
Red IQ, spell that out. So
it's RED like the color and then just IQ like your IQ test. I would recommend that if you're big in modeling your cash flows out or because everybody's information they send you is different. So what Red IQ will do is turn it into something that's a little more standardized on to the way you want to look at it. So it'll take your weird operating statement and put it into my weird operating statement. So that's a good app. It's not very expensive either. For a matter of fact, actually, we got a free year or two of it for doing a loan with one of the lenders here. So that would be one that I would do. On the personal side, the apps that I'm using right now a lot would be, I'm actually a big cyclist and I'm supposed to do 100-mile, a century they call it, 100-mile ride here. And so I have this ride with GPS. So I'm always looking at to make sure that I've done enough miles. You have to build up enough miles to be able to do it. So I've been staring at that along with my fantasy football.
Tell our listeners how they can find out more about you or get a hold of you or, feel free to plug whatever you would like.
So yeah, my company is called Railfield and we're an owner of multifamily properties. We're primarily active in the mid-Atlantic, southeastern Texas, although, we theoretically can go anywhere. And our website is Railfield. So it's like rail, like a railroad, field, like a field, Railfield. It's railfieldrealty.com. And you can email me, jsiegel, jsiegel at railfieldrealty.com. I'm always looking to meet new people and make connections. As we talked about, relationships are important in this business. So, and you never know where they're going to lead. So it makes it kind of interesting.
Absolutely. Well, Jon, thanks for coming on the show today and just taking the 30 years of incredible experience that you've had and sharing some of that insight with us, especially about access to capital and sort of like how that's changed over time and what the effect that's had on real estate investors and what we do. It's been a really fascinating conversation. Thank you so much for having it with us.
Yeah. Thanks for having me. I appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.